Good morning or good afternoon, evening, depending on what time you're tuning into this webinar on exit planning. This is part one of a series of webinars that we'll be releasing on the exit planning process. So welcome. I hope you find the content useful and interesting. My name is Rich Grover. I'm a senior manager here at Hazelwoods, and we'll move on to now the agenda for the series of webinars. So today we'll look at parts 1 and 2 being what is exit planning and how do we maximise and protect value. Then subsequent webinars will look at the valuation of businesses, what the various different exit options are, the due diligence process, etc. So a little bit around the Hazelwoods corporate finance team. A team of 26, including 6 partners, and last year we advised on over 200 deals worth £1 billion in terms of both buy and sell side advice, whether that be financial or tax due diligence, acquisition advisory, sale mandates, management buyouts, etc. So we've got a huge range of experience in a wide range of transactions. And we obviously will be pleased to have conversations with you around your individual business and your personal situation and needs going forwards. So if we move on to the exit planning process, so what we're looking at here is not a single event, but more of a system, an approach which will result in your transition out of the business, hopefully gracefully. And this really is something that should be thought about 3 to 5 years in advance, ideally. Clearly, if necessary, that process can be shortened, and we are able to assist if your time horizon's much shorter than that. However, initial thoughts to how best to exit the business 3 to 5 years out is the optimal time to start that process. It's estimated that less than 10% of business owners have taken steps to plan for their exit, even though everybody will leave their business one day, voluntarily or otherwise. So what are the reasons that people might sell their business? Obviously, retirement is one of the most common. We're finding less and less that people are handing their businesses onto the next generation in terms of children who may have different aspirations. I mean, if you do have family succession, then that's absolutely fantastic. But we're finding more and more that people want to divest of their businesses to realise that wealth that's been created and then enjoy that in whatever way they see fit. So retirement is a very common reason for sale, and if you're looking to retire, we'd be absolutely delighted to have a conversation around that. Moving on to the second point, sometimes people's life plans change. They may have found running the business through pandemics such as coronavirus, or for whatever reason has just become either too much for them or not what they want to do anymore. So they want their life to take a different direction, so they want to sell their business to facilitate that. We've got another point around entrepreneurs and managers. Sometimes entrepreneurs want to sell their business so that it can be sort of the corporatization of it, when it reaches a certain point, can be taken on by somebody else. Sometimes entrepreneurs are absolutely fantastic at turning an idea into a business and getting it so far. That's absolutely superb. However, struggle with the sort of then the corporate governance and the management structure and all the sort of bureaucracy that comes with it, and they may decide to sell it to private equity or trade buyer, and then sort of go away and perhaps start, if they're serial entrepreneurs, start a different business, or depending on their life objectives and the amount, then perhaps they'll be on a Caribbean beach somewhere. Who knows? As I alluded to earlier, family succession is becoming rarer. Not to say that it doesn't happen, but often that's tradition where business has been passed from one generation to the next is forever, for whatever reason, not practicable in this particular scenario. So the business life cycle will also have a certain degree of influence on transactions, sometimes significant investment, whether it be in plant and machinery, human resources, to take the business to the next level. The amount of cash that's required is more than the current directors are able to lay their hands on, and therefore it's a good idea to get either an investment partner or to sell the business to allow that sort of next phase of growth to be turbocharged by a boost of cash. In terms of identifying exit objectives, the key things to think about is when do you want this to happen? When do you want to be out by realistically? What price do you need to achieve or would you like to achieve? Who might you sell to? Is it a competitor? Could it be a customer? A business that's in a related but in industry? Private equity with a particular interest in your sector. It's time to start formulating ideas around who your buyer might be and what they might look like. Important to obviously think about key employees. They may be your exit option in terms of a management buyout, or they may be instrumental in facilitating your exit as a trade buyer or private equity investor. Will see them as critical to the ongoing success of the business, so retention of key employees, key consideration. Shifting family wealth may be an issue around reasons to sell, and as we said earlier, sort of the next phase of growth and investment may also be a driving force in terms of behind a transaction to allow the business to flourish in the next level. So in terms of maximising and protecting value is typically driven by a profit multiple, or EBITDA multiple as we would refer to in the corporate finance world. So in terms of maximising value, we want to get current and forecast profitability as high as possible. So you're purely chasing the top line in terms of revenue. If it doesn't increase ultimate profitability, will not be a fruitful exercise. So focusing absolutely on profitable growth will obviously maximise your exit value, and that's sustainable profitable growth in that sort of the last 12 months or so and into the future, so that any buyer or investor is really bought into the fact that upward trajectory will continue. Securing recurring contracted revenues from customers, so where you're able to, depending on your industry, if you're able to tie your key customers into long-term sort of contracts, then that obviously reduces risk from a buyer's point of view, so will increase the multiple that they are prepared to potentially pay for your business. Demonstrating growth opportunities as well and having a strategic plan around them. So obviously we would want to go after the low-hanging fruit in terms of growth throughout the process, and making sure that we've maximised the sort of short-term growth options, but we would then present to a potential buyer that there is still market on the table in terms of future growth. People don't tend to buy businesses to watch them flatline. They want to buy into the fact that there will be future value creation through growth strategies that are clearly identified, and therefore we would be looking to present that potential for further growth through part of the sales process. Building a strong and motivated management team will also be absolutely key for obvious reasons. If you are going to exit the business when a transaction occurs, then your management team will be those who are working with the new owners to drive performance in the future. So identifying who they are, nurturing their capability, ensuring that they're suitably incentivised, be that through salary, bonus, share schemes, or whatever is appropriate for their role, will also be really key in sort of locking in that value, so that any buyer can see clear second tier management strength, which again will reduce risk from their point of view and give them confidence that their investment is in safe hands going forwards. Reviewing operations, so looking at brand and intellectual property, so protecting that by patents or other means. Checking compliance with employment, health and safety and other legislation. Clearly, we don't want any buyer or investor to find sort of skeletons in the closet through the due diligence process. It obviously increases risk from their point of view and can unnerve them. So making sure that our house is in order in terms of compliance with all relevant legislation, both general and specific to your industry, will clearly be key. As we alluded to earlier, securing terms of trade with customers, but also with suppliers, will sort of reduce dependency and make the business look stable, sustainable, and reduce risk from a buyer's point of view. So again, increasing the sort of multiple that they are prepared to pay. In terms of your customer base, obviously each business and depending on the industry, there will be variances, but typically a well-diversified customer base is going to attract a higher multiple. The reason being, if 60% of your trade is with one customer and they switch you off, then your business is instantly transformed overnight and you may not have the time or capability to recover that lost ground. Whereas if you have no customers that are more than, say, 5% of your turnover, the loss of any individual customer is has far less impact. So tying into long-term contracts and then sort of driving the bottom line through removing non-essential costs, and wouldn't go crazy with the cost cutting in terms of, we need to ensure that the cost base supports the revenue and ongoing profitability of the business. So I would certainly be looking to remove any non-essential costs, but I wouldn't be looking to cut costs so sharply that it damages the ability of the business to effectively trade and compete in its chosen market. So getting that balance right will be absolutely essential. So just continually along that theme, we need to ensure, and we hopefully already do have, robust financial systems and controls as part of any transaction. The numbers will clearly come under scrutiny, so both the accounts and those who are responsible for the preparation of the accounts should be in good shape, ready and sort of fit to enter any process. So again, just making sure the house is in order in terms of accounting and tax. Looking at the balance sheet and ensuring that where possible, where there is surplus cash that we've paid down debt. And in terms of working capital, thinking about our trade debtors and ensuring that we are collecting those in a timely manner and that suppliers' payments are well managed so that our working capital requirement over the 12 months preceding a transaction is as low as it can reasonably be within the terms of trade that we have. Maximising relief for capital gains tax will also be key, and entrepreneurs' relief has been replaced with business asset disposal relief, which enables business owners to dispose of shares or assets up to a value of £1 million, being taxed at only 10% subject to certain conditions, which clearly is very favourable. So the end result that we're aiming for, a business that's in shape for sale, both in terms of its trade, its staff, its operations, profitable and cash generative, strong management team with a sense of focus and direction, positive branding and image, a positive view in the marketplace, robust relationships with both customers and suppliers, and a market position that can be defended into the future such that any buyer or investor is in a reasonable belief that the current competitive advantage that is enjoyed by the business will be sustained over a number of years going forwards. Thanks very much for tuning in, and we will be releasing part 2 shortly. I hope that you've enjoyed today's session, and please do not hesitate to contact me should you wish to discuss any of the content that we've covered today. Thank you.